20 years ago, it took 2 people to carry $10 worth of groceries, but nowadays a 5-year-old can do it. What is happening here? Is the human species becoming stronger? I don't think so. It may not seem like it, but the money you so diligently save becomes less and less valuable each year. Thanks to the government printing money and other factors, your money is burning up at about 3% each year. And do you think that your salaries are rising with 3% each year? In fact, if you leave $100,000 in your bank and don't touch it for 25 years, it will be worth $57,852 adjusted for inflation. Except you don't see it because the numbers don't change. So you are losing money by saving. So what then? Should we just spend everything as soon as it comes in? Well, only if you want to be poor for the rest of your life. The only real option to combat this problem is with long-term investing, which is exactly what we're going to talk about today. Now look, I'm not going to pretend to know everything about investing, which is why we're consulting the book The Intelligent Investor by Benjamin Graham. And if you don't know him, he is the mentor of Warren Buffett, the most successful investor alive. I know this book is from 1945, which seems a bit outdated, but it's been updated every 5 years, and it's seen as the Bible to this day of value investing. The goal of value investing is to invest on a long-term basis in strong and established companies to increase your net worth steadily, safely, whether the market is crashing or surging. Don't worry if you don't know anything about investing. We'll start with the basics in this video, and in the next coming videos we'll focus more on the technicalities of investing. All right, let's get started. Alright, so let me explain the general gist of the stock market for those who are unfamiliar. A stock, or what the internet sometimes likes to call it, stonk, is a piece of a company that you can hold on to receive small quarterly payouts called dividends, or you can sell them later at a higher price to make profit. But it's important to realize that a stonk is not just a ticker symbol. It is an actual ownership interest in the company. And the stock price doesn't necessarily accurately represent the value of the company, but rather the confidence that all the investors have in that stock. Which I know sounds a bit shady, but in reality it's great news, because this means that the stock can be overvalued or undervalued. When a lot of people want to buy the stock, the price goes up. And when a lot of people want to sell the stock, the price goes down. Simple supply and demand. Stocks. Now all of these stocks combined are part of the stock market. The stock market is a pendulum that swings between unsustainable optimism, which makes these stocks way too expensive, and unjustified pessimism that makes them way too cheap. Now the intelligent investor is a realist who sells to optimists and buys from pessimists. Now let me say that again, but slightly different. The intelligent investor buys when stocks are undervalued and sells them when they're overvalued. By the way, if you were to invest in the entire stock market for a long period of time, you would make a return of about 6% a year, which is a hell of a lot better than minus 3% a year you get from saving. Which brings us to ETFs, because betting on the entire stock market is actually possible. If you don't have the stomach, or you just don't want the hassle of trading individual stocks, there's a great option out there called exchange traded funds, or I like to call them ETFs. And ETFs are basically just one giant package of a bunch of stocks and commodities that you can invest in as a whole. For example, you can buy an ETF with all the S&P 500 companies in them, which are basically just the 500 biggest companies in the US. Or you could buy an emerging markets ETF, which will consist of promising companies in South America or Asia. Well, you might think then, what is the catch here? Well, besides a 0.25% fee, absolutely nothing. If you're merely looking for a 6 or 7% return, this might be a really good option for you, because you don't have to just look at the paperwork of all these individual stocks, but you can simply just spread out your money between these ETFs, and you will make a reasonable return yearly. ETFs are also inherently very safe, because your portfolio will be very diversified because you have so many companies in them, which makes your risk very low. And the last option we will cover is bonds. A bond is basically a loan to the government or a corporation in which you are the lender and they are the borrower. A bond is always issued with an end date, 6 months, 2 years, 5 years or 10 years, at which point you will be paid back with interest, of course. This is by far the safest way of investing because the government never really goes broke. And if it's a corporate bond and they go broke, the corporation goes broke, they will always pay the bondholder first and then the stockholder. This is why it's a very safe investment. But you can see that in the return though. The returns are not as great as stocks. Only about 2 to 5% on average. It's not a lot, but it's a hell of a lot better than your money being inflated. Whether you're a defensive or active investor, or Benjamin Graham calls this the enterprising investor, it's always smart to have a mix of bonds and stocks in your portfolio. If you're a defensive investor, you probably want more bonds than stocks, and if you're an active investor, you probably want more stocks than bonds. If you're willing to take a little bit more risk, you should have more stocks in your portfolio, otherwise have more bonds if you want to play it safe. Or you can simply just split it down the middle. Investing is really not that risky as people make it out to be. It's only risky if you let your emotions take the best of you and you pull out too early. Yes, the stock market, it goes up, it comes down, but in the long term, it always goes up. If you look at the history of the stock market, it has always gone up to higher highs than the previous cycle. So please don't get left behind and get screwed over by inflation, because with saving, with that strategy, you're just losing money. In the next video, we will go deeper on how to invest like an intelligent investor. So please subscribe and ring that bell so you don't miss that video. If you're interested in reading the book by Benjamin Graham, The Intelligent Investor yourself, there's a link down below. Thank you for watching and see you next time.